What's up, everyone? How you guys doing today? Happy Monday. Man, that weekend was way too fast for me. Um, my name is Jeremiah Davis, and it's Monday Fun Day. How you guys doing today? Giving out funding tips. Um, if you don't know, let me tell you. My name is Jeremiah Davis, aka the Funding Coach. I am the owner and founder of Business Funding Now and about three other businesses. Um, and Monday Fun Day is where I give out funding tips related to entrepreneurs, small businesses that need to access funding to help you guys, teach you guys the different funding options that are available to you. Um, but today's topic is what does business funding look like in 2023, right? We're getting a lot of phone calls, a lot of emails, text messages, people asking me about qualification requirements for funding. The qualification and requirements for any particular funding product have not changed. All right. So um, there have been no new requirements. What is happening is the approval process has been tightened, has been more restrictive, but the funding is still available. If you should know what the qualification requirements are for any funding product before you start. Um, so yeah. So um, my staff. So, but it's really important that you understand that the funding, I mean, business funding or banking in general is affected by the economy, right? So, if you don't know what's going on with the economy is depends on who you ask, what side of the aisle you fall on, but funding. Put it like this: there's no new requirements for any funding product, but there are less approvals. Um, anyway, so my staff sending me messages, so I just see what they're talking about. We got clients trying to get funding. We got clients trying to buy software. We got clients coming out of our ears. So we need to make sure my staff is on top of it, which they are, no doubt about it. They always handle it. I don't know what I would do without them, but they are awesome. Anyway, so I wanted to tell you guys about what's going on in the financial realm, right? I just said that the economy affects the banking industry, right? The Fed has raised interest rates, what, about three times in the last 4 or 5 months here? And that has made a lot of things get restricted. So your interest rate on your credit cards, and on cars, on homes, on loans, all went up. When it comes down to funding, the banks have tightened their restrictions on their approval process. They haven't changed the criteria. They're just not approving as many loans as they was before this. I don't want to say recession. Some people say we're in a recession. Some people say we're not. Some people, the jobs look good, but the people aren't feeling it, at the gas pump and at the grocery store and things like that. And as business owners, if people are spending less money on any particular product or service that you have, and you need to get capital, then you need to know how you need to qualify, what you need to qualify for a particular funding product, right? Whether it be revenue based, working capital, business term loans, business line of credit, equipment financing, right? Because at the end of the day, the banks still have to lend money because that's how they make money. But they're not being as generous as they used to be before the economy changed up on us. So that's why I thought it was important. I got a funding report for about a couple of weeks ago. It's a quarterly projection of what the 2023 banking industry is going to be looking like, um, broken down quarter by quarter. So I'm going to go over that with you guys today, so you know what I know, right? And obviously, I am the funding coach, so I pride myself on trying to be as current as possible with the banking industry, as far as business lending is concerned, because that's my business. That's what I do. You know, I gotta make sure I can fulfill the loans for my clients and for my affiliates that they're looking for. And if I cannot, then the banks aren't lending. But that's not the case. The banks are still lending. They just have, um, like I said, tightening restrictions. Like the same credit score, same type of income requirements, same supporting documents. None of those things have changed. They're just being a lot more selective on who gets approved or what the term is on any approvals, right? Because if they'll still might approve you, but they might increase the term, the interest rate, and things like that. And so when you're presented with a funding quote, all right, that's most likely the best is going to get. Now, I can shop around and find other banks, but generally it's going to be the same type of scenario with these other banks, okay? Because at the end of the day, banks kind of mirror each other's qualifications and requirements, right? There might be some variation in it, but if it's the same loan product, the same qualifications Bank A has, it's probably going to be similar to or almost identical to, the qualifications and requirements for Bank Two or B. So, so that's the type of stuff we need to be, you need to be forward thinking in that. If you're an affiliate of Business Funding Now and you're still trying to get clients to sign up and get a loan through you and work through me and get your commission, I need you to know that you're not going to get the type of loans that we were getting, say, 6 months ago, okay? Because of the Fed raising interest rates, because of the economy, because of the, recession, if you will. But also, right? And every struggle, every tough time, there's opportunity, right? So I want to provide this information so you can seek out the opportunities to continue to provide services, funding, business credit to your clients, and continue to make money. Okay. So this is the report I got. All right. I'm just going to read it to you. So 2023 fourth quarter stats shows average U.S. consumer savings. 31% have no savings. 42% have less than $1,000 saved, and just 16% have $1,000 to $5,000. So when you add all that up, that is 89% of Americans basically have no savings and living paycheck to paycheck. Okay, so if you're a business owner and you have a staff or employees, that's where you're at. Okay, so for Q2, the second quarter, the banks and the credit unions have gone to a 5 and 24 underwriting, meaning if you have 5 or more new open credit accounts in the last 24 months, you are denied. Y'all catch that? Y'all catch that? Okay. And Q2, it's the second quarter of the year, right? Second quarter of the year, the banks and credit unions have gone to a 5 and 24 underwriting, meaning if you have 5 or more new open credit accounts in the last 24 months, you are denied. Many have also added a 4 and 90, which is if you have 4 or more inquiries in the last 90 days, you're declined. Due to inflation, they are also tightening their debt to DTI ratio, um, moving max allowed DTI from 45% down to 42%. So you need to have your DTI under 42%. Your clients need to have their DTI under 42%. Okay? And they should not have more than 4 inquiries in the last 90 days. Okay? This is what I'm talking about. All right? And then the predictions or the projections for Q3, right? Underwriting approval criteria expected to tighten again at the beginning of Q3 2023 due to a projected recession as consumer spending has slowed substantially in Q1. People are tightening their belts and banks are bracing for it. They have raised standard loan rates on an average of 3% in Q1. So when you was getting a loan for, say, 13%, all right, this is a signature loan, no collateral type loan, or maybe collateral-based loans, I don't know, right? But it just says the standard lending has been increased 3%. So now you're going to pay more for the same amount of money that you would last year. So that's the projections for the first, second, and third quarter, right? We're already past the first quarter. We're in the second quarter. And in the fall, we'll be in the third quarter. Okay? So if you still are trying to get people to apply or come to you for their funding, this is the criteria you need to look for. When you're looking at their credit report, you need to make sure they don't have more than five new accounts in the last 2 years. And no more than 4 inquiries, matter of fact, 3 inquiries in the last 90 days, in the last 3 months. And you also need to give them the proper expectation that they're going to pay higher interest rates until the end of the third quarter, and hopefully the recession or whatever it is that we're coming out of that, and we can still continue to move on. Because I mean, they're going to come down. Interest rates going to come down. The Fed's going to come down. You know, it's just a matter of when. Okay, this is nothing new. We go through this every 8 to 10 years. Okay, last time it was a housing debacle around 2008, 9. You know, so it's not the end of the world. We just have to adjust. We have to pivot, and we have to know what lenders and creditors are looking for before we apply. That's the end. That's what it is. That's what it's all. That's why I'm providing this information, so all of you will know what the qualification requirements, and more importantly, that you're giving your clients the proper expectation. The worst thing you can do is overpromise and underdeliver. Okay, you want to underpromise and overdeliver. Okay, that's what you want to do. You don't want to overpromise and underdeliver. Flip it up. All right, you want to say, yeah, well, we'll see, but you know, things are tight right now. Let me see what I can do for you, right? And I as a general rule of thumb, I don't like to pigeonhole myself into quoting amounts, interest rates, payments, or anything like that, because I'm not the bank. Okay, I'm not the one lending the money. The bank dictates the terms, right? And if I come back with the terms, and if I quote you a term, and I come back with a higher term, and then then I violated the trust, and I mislead, basically, right? So as a rule of thumb, I don't make quotes like that. I don't because I don't know, because the banks can change, and those quotes and those criterias, those offers, they can vary from bank to bank. All banks dictate their own criteria, right? So you can have 2 different banks offer the same type of loan and come back with 2 different offers, because they're 2 different entities. The individual banks dictate their criteria for their lending practices. And the loan officer usually doesn't even know why. They're just kind of worker bees typing in the information, and then the computer is already programmed with the criteria, and it comes back denied. And the banks, and for in the business lending world, banks are not required to tell you why they denied you. You're just denied. Simple as that. Okay, so just to recap, all right, just to recap, all right, I went through, right, 31% have no savings, 42% have less than $1,000, and 16% have $1,000 to $5,000 in savings. That was the stats. That's what the U.S. Consumer Savings Report says. When you add all that together, you got 89% of Americans have no savings. Okay, so whatever they're spending is on essentials because they don't have any extra money for anything else. You know, they're spending the money on the higher gas prices, higher grocery prices, all those things that they need for day-to-day living, right? And they don't have any extra money saved up. Okay, because most likely they're paying more for the same gallon of gas. They're paying more for the same loaf of bread, the same eggs. You know, I did see the eggs in this area where I live at come down a little, but it was still, $5 for a dozen of eggs. You know, I just bought a 30 pack, and it was $7, and that was generic brand. So anyway, okay, and then the underwriting tightening in Q1, right? So banks and credit unions have gone to a 5 and 24, meaning they have 5 or more new open credit accounts in the last 24 months. If they have 5 in the last 24 months, they will be declined. Okay. Many have also went to a 4 and 90, meaning no more than 4 inquiries in 90 days means decline. This is due to inflation, that they are tightening their DTI, debt to income ratio, max allowed DTI from 45% down to 42%. Okay, so that means you have to pay off more of the debt. You have to have your credit cards more paid off than you did. It's only 3% more, but that could be substantial for some people. All right. So as a guideline, just look for individual trade lines have to be paid down under 40%, and overall DTI need to be under 40% as well. All right. Individual under 40% and overall DTI under 40%. Okay. That way you reach a safe benchmark. Okay. And then for Q3, the third quarter, underwriting criteria, approval criteria is expected to tighten again at the beginning of Q3 due to the projected recession as consumer spending has slowed substantially in Q1. So they're making a projection about Q3 from Q1. People are tightening their belts and banks are bracing for it. Okay? So people are not going to be spending money. That means buying new cars, buying houses, all the things that make our economy go. If we have to spend money to make money, right, in our economy. So, all right. So just know this is not going to end in the next 3, 4, 5, 6 months. Okay. Hopefully by the end of the year, during the holidays, the Fed will bring down the interest rates and the economy can get back to moving a little more smoother than it is now. All right. So, so all this means that we're still going to be doing funding, right? Banks are still going to be lending money, but now we have to be a little bit more selective or preparing our clients to get the money that they're looking for with these new guidelines. Okay. That's what we're talking about. That's what we're talking about. So, you know what? I'm going to put this in an email and send it out to all my people on the email list so you guys know what you're looking for and you have it in front of you. Okay. Matter of fact, I'll whip it up tonight and put it in more broader terms so everyone can understand it. And then I'll also create a flyer and post it, and then I'll send it out to everybody in the email. But yeah, all right. So That means we just got to buckle down. We got to work a little bit harder. That's all it means. And we still keep it moving forward. Keep it moving forward. Keep it moving forward. Okay. So I'm going to cut it off now, and I will catch you guys on Friday. I do have a special coming out on Friday for Mother's Day. So be on the lookout for that. Catch me on Friday at 5 o'clock from Black Label Friday, and I'll be going over software tips and things like that. All right. So, yeah. Do I got any questions before I sign off here? Okay. So, hey, DTI, individual trade lines under 40%, no more than 3 inquiries on the credit in the last 90 days, and no more than 5 open new credit accounts in the last 24 months. Okay? Those are the things you're looking for to get your clients qualified for funding. My name is Jeremiah Davis. I am the funding coach. Peace.